Welcome back. Well, let's put the spotlight on the financial space now. We've been speaking to players from the banking and NBFC sector to assess the impact of RBI tightening the loan provisioning norms to check the rapid surge in unsecured retail loans. Today, we'll be speaking with the management of IIFL Finance. The company's president and group chief financial officer, Kapish Jain, is with us. Kapish, thank you very much for taking this call. So it was a sort of a twin-pronged tightening, right? One on the unsecured side, all the personal loans, credit cards, etc., and the other was that the lending that's happening to NBFCs from banks. Let's take up the second part first. I mean, how might this impact you, your cost of funds? What are the conversations that you've had with your bankers of the past couple of days?
Well, the only exemption to that is any lending to housing finance company would not be having higher risk weight, and any lending towards private sector will also not have higher risk weights. Subject to that, for a normal bank borrowing, the risk weights at the bank side would be higher when they're lending to NBFCs. So at aggregate level, our impact is lesser, but the banks would likely to raise their rates. There's no reason why they would not, because they would now allocate higher capital. So that's where there's a disconnect. We would be representing to RBI saying when banks are lending towards a secured asset product, then they are not need to levy a higher RWAs when they are lending directly. However, when we are lending to NBFCs like us, which is largely into secured products, by general law, they would now put a higher risk weights, and therefore banks would be benefiting, and we would be at a loss, and we would have to either increase the rate of interest to our borrowers or either hold back some of the lending here. So our representation will be going to RBI in a day or so, requesting them to revisit this because this might impact the overall borrowing cost for the MSMEs and SMEs in particular, who are taking these borrowings for commercial reasons and not for personal.
So, Kapish, exactly that's what we wanted to understand while you make the representation, and let's see how RBI responds. What is the increase in cost of borrowing that would have been calculated as of now for let's say, IIFL Finance?
So it is actually too early because no bank has come to us about their on hiking our rate of interest. But let's assume that they hike it up by around 25 basis points for a 25% RWA. On an aggregate basis, I have a 15% of this borrowing which might get impacted. So the overall impact for now looks very minuscule, maybe around 4 to 6 basis points, depending on how much the banks increase their rate of interest for such kind of bank borrowings.
So
at a consolidated level,
right, Kapish, hi, morning. So your borrowing from banks is only 15%?
Yeah, at a consolidated level. So I've got IIFL Finance, where the bank borrowing is around 26%, which would get impacted. But given for the housing finance company, they are exempted. And the Samasta Microfinance, which is all private sector borrowing, they will also not get an impact. When it converts to an aggregate level, the impact is around 15%.
And all of it is most of it is floating?
They would be. So I'm only talking about the borrowings from banks which are of floating nature and might get impacted with the RWA.
No, I'm talking about your customers. They're all on most.
Oh, for my customers, they are actually by nature they are fixed rate borrowings, lending. However, the agreement does allow us to hike up the rates on a prospective basis if there are regulatory reasons behind it.
This representation that you're making, is this because we've heard it from other NBFCs over the last few days as well that they're seeking clarity? So is this an industry representation which is going to the RBI, or what's happening?
So there's a body called FIDC which just represents NBFCs. So FIDC does making a representation. This might impact the lending to MSMEs for commercial reasons, or would increase the rate of interest. So there's a general representation which has gone to RBI. We are just topping up with something more specific to us.
Okay. Kapish, hi. Good morning. I wanted your thoughts a little bit on the overall business as well, what you're doing in terms of asset quality. What is the situation now? And given the kind of improvement that we see in the economy, do you think that there could be further improvement in your own business and your asset quality?
Our asset quality is holding fine. Across product segments, holding fine. We have given a guidance of an NPA of not more than gross NPA of not more than 2%. We are shade lower than that, around 1.8. And if I shave it off and if I slice it off across products, they're all holding fine. The one big barometer for asset quality check on a near-term basis is how is the collection efficiency looking, what has been the bounce rates, and so that way they're all operating fine. So I don't see any concern on asset quality. Across organizations, and more particularly for IIFL Finance, we have been a little more focused here, making sure that we have teams which are dedicated to early bucket collection and the hard bucket collections. And with their expertise coming on the ground, the collections are very closely monitored.
Okay, but you're not seeing any stress at all across whether it's gold loans, home loans, in the sort of rural side of the market. I'm just trying to understand whether you see any stress there. And
No,
also
see,
in terms of
gold is-
growth, what kind of growth targets do you have for the full year?
So, so over the last 5 years, just reversing it a little, we've grown at a CAGR of around 23%. We've seen COVID in those times, liquidity crisis also hit us. Going forward, we've given a guidance that up till FY25, we look to grow at around 25% CAGR. We seem to be on track at this midpoint check at H1 of FY24, where we have been able to meet the 25% target at an aggregate basis. We've expanded significantly, added a lot of branches across all our product segments, be it gold, home loan, MFI. With that kind of expansion that we have done, we believe that we should be able to sustain the growth target that we have given to the market as a guidance.
Kapish,
Purely by expansion and distribution, you have reach available to them. Yep.
Okay, sorry.
Yeah.
Just to just very quickly cover 2 points. One is just give us the extent of unsecured exposure in your book. Like you mentioned, home loans are fine, secured, MFI is fine. But how much of your book is unsecured? And give us just the thought process behind this Japanese loan that you've taken, the ECB that you've done with the Japanese bank. Why that source? Are the funds cheaper? And where does it take your blended cost of borrowing?
So coming to the first question, unsecured, you need to further dissect. So our overall unsecured portfolio, MFI is around 15%. 10% is in the unsecured portfolio otherwise. But then if you need to slice it off, unsecured for consumption purposes. That's where the risk weights are supposed to go up. So if you're looking only that segment, then my unsecured portfolio is around 12-13% at a standalone IIFL Finance level. But if I aggregate all my aggregates all my other companies as well, there the number falls in even lower at around 7 to 8%. So therefore, unsecured portfolio at aggregate basis is a single digit number. For unsecured given for consumption purpose, that's where the risk weights are going to get impacted.
That's 12 to 13% at IIFL Finance level you mentioned. And there you'll be passing on the higher cost of funds when risk weights go up. So will it be very simple that loans simply get a little costlier? Do you see that impacting your growth?
No, not really, because the portion of unsecured portfolio in our overall book is very minuscule. And given even if the growth tapers down at an aggregate level, it really wouldn't make a huge difference. It's a single-digit portfolio and at overall AUM of around 73,000 crore. So therefore, even if it tapers down a little and goes slow, it doesn't really going to make a huge dent or impact for us on overall growth numbers.
Okay, and Kapish, just 20. Yeah, exactly.
Yeah.
20 seconds left on that. If you could talk about the loan from the Japanese bank.
So loan from the Japanese bank, so getting a loan from a Japanese institution is really a testimony of our performance and our credibility as well. It opens new doors for us. It is not easy to open that market because these institutions are fairly detailed, very specific, and they would need to draw a lot of comforts on overall performance. So we believe that this is going to open new markets for us, more particularly a Japanese market is more of a developed market, and will make availability and acceptability of our debt paper far bigger in the global space as well. The funds have come at a very good price. So the funds have come at a decent price, almost in line with the rate at which we are borrowing incrementally, maybe a shade lower. So therefore, both ways is going to be really beneficial for us.
Okay. Got it. Kapish, great to have you with us here. Thank you very much for your time. It's a pleasure speaking with you here on CNBC. Well,